And in financial accounting, you prepare financial statements, and there are two statements: income statement and statement of financial position. Now, in income statement, you list down all of your expenses, and in balance sheet, you put down your assets, liabilities, and capital. Now, when you buy assets, and that's what you have learned in financial accounting, that when you buy assets, you do not put them in your income statement as an expense, but you actually keep them in your statement of financial position as an asset, and every year you charge depreciation on those assets as an expense. So in financial accounting, that is allowed. However, the concept of depreciation is that there is no fixed rule on how much depreciation should be charged on different assets. As a result, different accountants, different companies, they would charge a different rate. One would charge maybe 2%, the other would charge 5% or 10%, whatever they feel is appropriate. However, taxmen, they don't like this flexibility because obviously because of their experience with accountants. So they set rules about how much depreciation should be charged on assets. Sometimes they actually very, very generous, much more generous than the concept of depreciation. You would never be allowed to charge 100% depreciation on an asset. However, taxmen does allow that. So it's the same depreciation, but it's for tax purpose. And in tax language, we call it capital allowances. However, the concept is very similar to the depreciation. So we'll talk about what, to be honest, I've just said the general principles about capital allowances. I've already said that. So these are the general principles. We will look at what qualifies as a capital expenditure in tax. Obviously, we know that assets are the one, fixed assets are the one which should qualify. But then there are different rules in financial accounting and tax. So we will look at the differences there. The main qualifying expenditure is plant and machinery. So we'll talk quite in details about plant and machinery and capital allowances on that. Actually, most of this lecture is about plant and machinery. We have different rates of depreciation, and one is main pool and special rate pool. So we'll discuss what are these, and we will have writing down allowance, what that thing is. Two very prominent feature of capital allowances are annual investment allowance and first year allowance. So we will talk about these as well. What is balancing allowances and charges, and then what is non-pooled assets. There are a few things in your chapter which I have excluded from this lecture, and those topics will not be test as well. So those are cessation of trade, structure and buildings, and miscellaneous capital allowances. We will not cover these areas. Moving on to the next slide. General principle, guys, I discussed that what is depreciation and what is capital allowances is basically the same thing. So we calculate capital allowances just like we deduct depreciation in our income statement as an expense. Capital allowances will be deducted from our taxable profits in income statement for our tax purpose. Yeah, so basically income statement. So these are the general principles. Qualifying expenditures. The main categories of capital expenditures which qualify for capital allowances are plant and machinery, and then you can see in grayed out structures and building, patents, know-how, and research and development. So these are the 5 things which are mentioned in your books, and you would be wondering that, hang on a minute, what is happening here? We're only doing 1 thing out of 5. Well, that is true. But the reality is that plant and machinery is the most important category, and even in your book, around almost apart from the last couple of pages, uh, uh, it's all about plant and machinery. So that's what you need to know most of the time. And obviously, the rest of the stuff which I'm not discussing, it will not be tested as well. So let's look at plant and machinery now. So plant and machinery is not defined by statute. It has left mainly to the case law. So case law depends. What happened in the past? The businesses, they claimed that this expenditure was plant and machinery. Taxman said, we don't agree with you. So they took it to the courts, and then the courts decided on each and different things if they would qualify as plant and machinery. So we have a quotation from one of the case which was in 1887, more than 100 and more than 100 years old. So apparatus used by businesses for carrying on their business, all goods and chattels, fixed or movable, which he keeps for permanent employment in his business. So that is one of the definition. Again, different cases would come up with different definition on plant and machinery, but I think this is one of the guiding principle of the on the matter. Machinery of all types, motor vehicles, office furniture, and equipment all qualify as plant and machinery. You would have noticed this thing, when we talk about financial accounting, we say plant and machinery, motor vehicles, fixed furniture, and fixture. So you see, the fixture is actually not there. So the fixture actually is an item which is most contested between taxman and the businesses about should it qualify as plant and machinery or not. So let's look what our slides say about fixtures. Now, general rule is if an item of fixture actively perform some function for the trade, then it will be treated as um, plant and machinery. So in display lighting, for example, you see the name board outside the shops which tell the name. It would be considered that is actively marketing for the business. However, there would be few things which would be part of the business, but they would be more passive in in the trade. So passive means that the trade would still carry out if this stuff does not exist. You must have noticed these garages have a shed, cloth shed outside, and they do a bit of fixing over there. That is one example. But for example, Sainsbury's, they have offices, they have shops, and that's their active trading. But then they have offices where they do general. Now those offices, although they are buildings, and there is so much stuff which could qualify as plant and machinery, but because they are a passive function, those offices, they would not be considered as plant and machinery. However, when Finance Act comes, it specifically mention few areas of expenditures which should be considered as plant and machinery. So basically, why it does, it wants businesses to spend money on these things, obviously for the benefit of economy or the benefit of the environment or whatever the reasons are. They promote those things. So they say, oh, you know what? You can call them plant and machinery. We are actually calling them plant and machinery, so you're allowed. We would be wondering what is the benefit of this, calling something plant and machinery, and if it's not plant and machinery, then what is the case? Now the thing is, if you are able to categorize something as plant and machinery, then you can charge a higher rate of writing down allowance. That means higher depreciation kind of thing, and that means lower profit. Expense goes up, profits comes down, so you pay less tax. So that is a benefit for the businesses. So that's why businesses would always try to put something as plant and machinery. If something doesn't fall as plant and machinery, it would fall under structures and buildings, and the rate on that is much lower. We will discuss that later on. The rate is much lower, so that would mean that the tax would be higher. So businesses, they want they try to put everything in plant and machinery for that reason. So examples there are thermal insulation, obviously for environment, expenditures on personal security, expenditure after 5th April 2008. That's a long time ago. Integral features of a building. These integral features, for example, lifts, escalators, and heating and cooling system, for example. So these are integral part. They go into special pool. We will discuss that. Expenditure on computer software and expenditure on building alterations required for the installation of plant and machinery, just like just IAS 36 36 PPE, property, plant and equipment. It says that if you spend some money to put the asset into operation, that cost should be added to the cost of the assets, and it should be capitalized, and then the depreciation should be charged. Similarly, taxman says the same thing, that if you spend some money on putting an asset in your building and then using it to produce things, then those costs, not just the cost of buying the asset, but the cost of running the asset as well, at the start should be capitalized, and then writing down allowances could be applied on those expenditures. So I was talking about pools. So we have a slide on pools now. So generally there are two pools: main pool and then special rate pool. Now main pool is for everything else, and generally it's all plant and machinery goes. The rate is higher, 18%. You can ask for 18% um, writing down allowance, as you will see in one of the examples, hopefully in this lecture. So that is quite high. You can claim that on that pool. However, there is a special pool which is 8%. I think the rates are coming in the next slide, so we will talk about that anyway. So there are special, there are other assets which go into special rate pool. Generally, is the integral features of the building we just discussed in the previous slide, and then cars with emissions more than 110 grams per kilometer are allocated to the if it's more than that, then it would go to special pool. If it's less than that, it would go to the main pool. However, if it's even less than 50 grams, then they would actually not go into any pool. The taxman is very generous on that matter, and they say you can claim all of the money spent on a car which emits less than 50 grams per kilometer into income statement, hence reducing your profit and paying less tax. So you don't have to, if it's something less than 50 grams, you don't have to put that in any pool, simply into the income statement. Writing down allowance. So I have already explained this bit. Just like depreciation, it's writing down allowance. It works pretty much like reducing balance method. Do you remember that? Two ways of calculating depreciation. One is straight line and the other one is reducing balance method. So writing down allowance actually works pretty much like reducing balance method. So for each pool, the rules are now how you should calculate the writing down allowance. So what you will have an opening balance for each pool. Main pool special pool. So first of all, if you buy anything extra, the cost of any plant and machinery acquired, you put it there. However, you don't do it. So let's say I bought some. I just started business and I have nothing in my any pools before. So I spent 50K on plant and machinery. I put it in my main pool. However, I wouldn't do so if I can claim FYA, which is first year allowance and annual investment allowance. These are coming later. So if you claim those, then you don't have to put them there. Any plant and machinery disposed of. So first you add, then you get rid of whatever you have sold, and then what do you put there for the things you sell? The rule is lower of the sale proceeds and original cost. So if you bought something for 12,500 and you sold it for 11,000, you put 11,000 there. So lower amount would be reduced from the main pool or the pools. And then you calculate WDA, 18% or 8%, whichever the relevant pool rate is. I've already mentioned these things. WDA in the main pool is 18%, and WDA in the special rate pool is 6%. It used to be 8% before 6 April 2019. However, you don't have to worry about 8% at all, because none of the questions in your MCQ would have a date of 6th April 2009 prior to 2006 April 2019. So you don't have to worry about on this matter. So you will not have to calculate 6% and 8%. Yeah. So WDA is scaled up or down if the length of the chargeable period is more or less than 12 months. Obviously, if it's whatever you're writing down allowances, if the period was for 8 months, you will 8 by 12. If the period was 15 months, you'll do 15 by 12. We'll do the numbers and it will make more sense there. WD is not restricted by the length of time an asset has. Oh yeah, that's one more thing to understand. When we do depreciation, we actually calculate an annual rate for example, 10%, and then we only bought it for 6 months in this year, so let's do 6 by 12. In capital allowances, we don't do that. Even if you bought the asset right at the last day of the year, you would put that as you bought it at the start, and then you will claim WDA, which is good for the business actually, because they can claim the whole year WDA rather than. So see, taxman is generous in this area. One thing I would like to mention here that there could be a situation, say this 6th April 2019. So there could be a situation when a business buys something before 2019 and then sells it later on. In that case, you will have to calculate WDA at 6% and 8%. What I can tell you that this will not be tested. So this detail is given on page 160 of your book. So you don't have to read that. Basically, you can just exclude it. So page 160, changes in the rate of WDA. They were a bit of a complicated issue. I thought let's exclude it from our module. And the relevant example is example 2. So you will not be tested on changes in the rate of WDA, example 2. However, please do not confuse this with changes in the rate of annual investment allowance, which is coming up later. Okay, apart from main pool and special rate pool, there are some other pools as well, which are coming later. However, another thing is if there's only £1,000 left in any of the pool, main pool or any other pool, you will just claim all of it as writing down allowance, and then you will just get rid of that pool, um, to make life easier for both business and taxman. So you will not apply the normal rates of 18% and 6% if this is the case. This leads us to a very interesting topic, which is annual investment allowance. I have seen a couple of questions actually on this topic in your test for this chapter, so it's worth uh, understanding it properly.